terms of sustainability, we will not do it for any other country from the Eurozone. I'm asking you to realize the importance of this decision. Because in this sustainability problem, we're dealing with the risk of contagion.
All right, so that's what the French President Nicolas Sarkozy had to say. Will, does that sound likely to you?
Well, there are questions already being asked, of course, if the private sector can be involved in the Greek bailout when they need more money. Surely that could be the case if Ireland and Portugal, the other two nations that have been bailed out already, if they need more cash. So maybe down the line we will be seeing calls for more private sector involvement. But as we see, the politicians are saying that's not going to happen right now.
All right, and apart from the bailout for Greece, what else was agreed on in terms of next steps at that summit?
Well, Ireland and Portugal have also been given interest rate cuts, so that's made the repayments easier for them. But most importantly, perhaps, the European Financial Stability Fund. This is it was the emergency lending fund set up at the peak of the financial crisis for European governments. That has had its remit very much expanded. In fact, Sarkozy was referring to it as perhaps a nascent European monetary fund. The equivalent to an IMF for Europe. So this is quite a large step towards further financial integration for the European Union, for the Eurozone certainly.
All right. Well, the Eurozone leaders there saying that they hope this new bailout will put a lid on the region's debt crisis. But not everyone's convinced. Let's take a look now at the rollercoaster ride the Eurozone has been on since the financial crisis of 2008.
18 months ago, Greece revealed that its debt and deficit figures were far worse than reported. For years, Greek governments had falsified the country's balance sheets, hiding huge expenses. It emerged that its deficit had never been under the 3% limit demanded by the EU. When government debt reached 130% of GDP, Greece could no longer borrow. The crisis was impossible to handle, and Athens turned to Europe for help.
It's absolutely necessary to ask our European partners for help. We need them to activate the European support funds that we created together.
Greece had the biggest debt in Europe, but it wasn't the only country to struggle with its deficit. In order to stop the crisis from spreading across the Eurozone, the EU and the IMF decided to pay. In May 2010, they lent Greece 110 billion euros over 3 years. In return, George Papandreou's government had to slash its budget. But this wasn't enough to stem the crisis. A year later, the Greek debt stands at about 150% of GDP. On Thursday, EU states agreed on a second bailout plan for Athens. EU leaders hope it will be their last. The bloc had already offered similar packages to Portugal and Ireland. And experts doubt it can keep bailing out its struggling economies.
All right, so lots there for investors to digest.
A common response to the crisis situation. Our meeting was focused on European leaders defending the financial stability of the euro area.
So what has been agreed? The European Union and the International Monetary Fund will cover Greece's financing black hole with an estimated 109 billion euros. They've pledged to lower the interest rates Greece faces on its debt, making repayments cheaper. More time to pay back the cash of between 15 and 30 years is also on offer. And the financial sector has also agreed to help, its contribution as much as 37 billion euros. The agreement will also see a reduced rate of interest for Portugal and Ireland, two more European countries suffocating under mountains of debt. Finally, there were signs of agreement between the Eurozone's biggest players, France and Germany, after months of dithering and bickering. This emergency summit was the 10th meeting in the last 18 months. Widespread disagreement amongst the Eurozone countries has added a dangerous political dimension to this economic crisis. Now, the details in the final communiqué are still vague. They'll be set out at a later date. But what is clear is that private investors will be making voluntary contributions, a strategy which could be construed as risky. It is unclear whether this will trigger a technical default and with it further contagion in the Eurozone. But leaders went to great lengths to stress that the problems in Greece that have provoked rioting on the streets are exceptional and no other countries will be allowed to countenance the D word.
We clearly said that Greece is a specific case. We will do it for Greece, but we won't do it for another country.
Reassuring promises, but are they enough? Despite the united front, attention will now move to the financial markets and the verdict that matters on the final deal. Alex Rossi, Sky News, Brussels.
To do, but you know, when 17 people and 17 nations are sitting around a negotiating table all the time, it's always a cumbersome process. It has been like that ever since the EU started, and it's going to continue in that way. But at least there was a feeling in there that there was a kind of quantum leap. Whether that holds in the light of day, we remain to see. Also, Georgios Papandreou, the Prime Minister of Greece, was very confident that this would put the Greek economy back into a position where it can at least grow itself out of the crisis. This is what he said.
We now have a program and a package of decisions which create a sustainable path for Greece, a sustainable debt management for Greece, and this in the end, of course, will mean not only the funding of a program, but it will also mean the lightening of the burden on the Greek people.
Of course, we could argue cynically that this deal we could have had weeks ago. We've been dancing around the credit rating agencies and whether something would be a credit event or not a credit event. And now we've done something that will be a credit event in all likeliness for the agencies anyway. Ever since the ECB opened that door by saying a couple of weeks ago, you know what? We decide when there is a default, and unless it's a default in our dictionary, we don't have any problem with the collateral. Ever since that sentence was on the table, it was clear there would be movement. As much or not they're going to be spooked by what the agencies might do right now, well, we have to remain to be seen. But at the moment, the markets are still giving it the thumbs up, so maybe it's not so important right now what the credit rating agencies say.
OK, well, let's get Valentin's take on this. Valentin van Nieuwenhuysen is the chief economist at ING Investment Management. In your world and in the market world, how important is it what the rating agencies say in reaction? We already had a sneak preview from the rating agencies previously that they would say, yes, this is a selective default.
Yeah, absolutely. And I think this is quite interesting. To some extent, you could wonder whether this is a prelude to something where European policymakers more aggressively sort of try to diminish the role of rating agencies. But it doesn't mean that at this stage they are not important. For example, think about all the benchmarks that a lot of institutional investors use. If some of these countries, for example, it's relevant now for Portugal and Ireland, get downgraded further, they will be automatically pushed out of these benchmarks and there will be forced selling flows still today on the back of these adjustments in ratings. So I still think that they play quite an important role, and once these announcements come, it's quite interesting to see how the market will react.
Sylvia, the ECB has been keen to point out that they essentially set their own rules, and despite what the credit rating agencies might say about Greek debt, they can decide to overlook these ratings. At least that's the impression I'm more latterly getting, despite all their protesting previously about not wanting to see any kind of default. What difference will it make for the ECB if we do hear from the credit rating agencies, do you think?
At this stage, I'm afraid to say none. Not unless there is a, what do they call it, full-fledged default. If we're talking partial default, etc., it doesn't make any difference to the ECB right now. They've clearly said that for us, this is not a default. In our books, we have no problem with the collateral. Of course, if this is something, if this is a stone that rolls down the hill and gathers more moss as we go along, and Greek were to head into something that is called a clean-cut, a straightforward default on all fronts, then the ECB has a problem with definition, because then they hit the mandate that they say they can't take a defaulted country, because once there is no room to maneuver anymore, then obviously a country is in default. That's why they got the backstopper from in the treaty, in the communique right now, and the package that's been agreed upon, is saying if this is the case, then you, i.e. the ESFF, will pick up the tab and the ECB will not be lumbered with this kind of contaged collateral or damaged collateral in there. So they've got a bit of a backstopper in there, and at the moment, if they say it's no default for them.
Sylvia, question. What would you make of this, the impact it has on the credibility of the ECB? We've seen the ECB saying it will not buy bonds in the secondary market, and 3 days later last year they did it. Again, they've pushed very hard on this story of not accepting defaults, and all of a sudden now it's not important for them anymore. To what extent is there a fear that at some point this is really undermining the credibility of the institution?
Well, if you look at what the central banks around the world, what kind of pills they had to swallow over the past years, I think the ECB is probably the one that has the least bitter aftertaste in its mouth right now. But yes, they always have to be concerned about their credibility. It's a young central bank with a young currency. That's maybe why they were so fundamental about it. But at the end of the day, they didn't have any choice. They got themselves whatever kind of insurance they needed out there. What the ECB wanted to avoid at this stage is being lumbered with a collateral that is damaged essentially or worth nothing, and then having to go cap in hand back to the governments of the Eurozone, and not only of the Eurozone. We know that even the other governments outside the Eurozone have a part in the ECB capital. Go cap in hand back to the governments and say we need more capital, even though it wasn't their own fault. So I think the ECB could go away here with a sort of quiet smile on their faces. They got the insurance they needed. And talking about the credit rating agencies, that's a few lines in the communique that got sunk in all the other important matters. They do also say that they will that we're talking about setting up an independent credit rating agency, and we're moving a step closer to that, even though we waited for a year, and also to reduce the dependency, like you said, in terms of benchmarking. That won't happen overnight, but maybe 2-3 years down the road, we will see something different in terms of credit events.
Let's see what the viewers have to say about the conversations we've been having this morning. Sylvia, thank you very much indeed for that.
Of all the papers, nobody's saying it shouldn't have been done. Nobody is being so Eurosceptical as to say, let Greece go, simply don't give them the money. So it's more some satisfaction, though clearly not joy, because there's German money going that way.
The chairman of News International, James Murdoch, has rejected claims that his evidence for Greece. The European edition of the Wall Street Journal is reporting that the French president, Nicolas Sarkozy, dropped his initial plan to impose taxes on banks to partly finance the bailout in order to secure Mrs. Merkel's support for a broader effort to deal with the crisis.